There is a document that most people in the West have never read. It was published in Qiushi, the flagship ideology journal of China's Communist Party, not leaked, not intercepted, published openly, officially, with the full authority of the Chinese state behind every word. In it, President Xi Jinping outlined a specific plan, not an ambition, a plan, to transform the renminbi into a global reserve currency, with a, quote, strong currency widely used in international trade and foreign exchange, backed by a powerful central bank, with the ability to attract investment and influence global pricing. That document was released in February 2026, 3 months ago. The response in Western financial media was mostly silence. Meanwhile, the US dollar had already fallen to its lowest level in 4 years. Gold had already reached $5,500 per ounce, an all-time high. And central banks around the world had already purchased over 1,045 tons of gold in 2024 alone, the third consecutive year above 1,000 tons, more than double the annual average of the previous decade. These things are not random. They are not coincidences. They are not temporary. They are the visible surface of something much larger, a transition that has been building for years, that accelerated in 2022, and that in 2026 has reached a velocity that most ordinary investors still do not recognize for what it is. China is not trying to replace the United States. China is already replacing the United States. And the difference between those two sentences, the difference between trying and already, is the difference between having time to reposition and finding out too late. This is Capital Briefing. If you're new here, subscribe right now, before this video continues. Capital Briefing exists for one purpose: to give you the financial intelligence that institutional money already has access to before the public narrative catches up. The stories we cover are not the ones making headlines on cable news. They are the ones that explain why headlines happen. Subscribe now. Activate notifications. Then we continue. Let me build the architecture of what is actually happening. The dollar's reserve currency status is not a natural law. It is not permanent. It is not protected by any treaty or constitution. It is a preference held by thousands of central banks, finance ministries, oil exporters, and sovereign wealth funds around the world who have chosen to hold their savings, price their commodities, and settle their trade in US dollars. That preference is the invisible infrastructure beneath every financial decision made in America. It allows the United States to borrow at lower rates than any other country. It creates structural demand for US Treasury bonds. It means that when American companies buy oil, it gets priced in their own currency. That is an extraordinary structural advantage. And most Americans have never thought about what happens when it erodes. Erosion is already happening, documented, measurable, irreversible. The dollar's share of global reserves has fallen from 72% in 2000 to approximately 58% in 2026. That is a 14 percentage point decline in 26 years. That sounds gradual, and in some ways, it is. But the trajectory has accelerated. The Q2 2025 release of the IMF's currency composition of official foreign exchange reserves showed a further sharp decline. The euro emerging as the primary beneficiary, but gold absorbing a significant and growing share of the diversification. Central banks bought 1,045 tons of gold in 2024, the third consecutive year above 1,000 tons. The annual average from 2010 to 2021 was 473 tons. That is more than double. The institutions with the most information about sovereign financial risk, central banks, are the same institutions that are most aggressively diversifying away from dollar-denominated assets and into gold. What do they know that ordinary investors are being told not to worry about? This is a good moment to subscribe before we go further. What I am going to explain next is the mechanism, the precise chain of events through which China's strategy translates into a structural change in global finance. This is not abstract, it is operational. And by the time we finish, you will understand exactly why the smart money is moving and what it is moving into. Subscribe now, then we continue. The architecture of China's strategy has four pillars, not one, not two, four, and all four are advancing simultaneously. Pillar 1, trade settlement in alternative currencies. China and Russia now settle almost all of their bilateral trade in yuan and rubles without using the US dollar as an intermediary. This was a marginal practice 5 years ago. It is now the default. Egypt, following its entry into BRICS, has begun settling significant portions of its bilateral trade without dollars. Egypt's Prime Minister explicitly confirmed in July 2025 that BRICS member states are increasingly adopting local currency settlements as part of a broader strategy to reduce reliance on foreign currencies. Brazil and China have had an agreement in place since 2023 to eliminate the US dollar as an intermediary currency and trade directly in reais and yuan. The renminbi now accounts for approximately 50% of intra-BRICS trade. These are not aspirational targets. These are current operational realities. Pillar 2, the gold accumulation strategy. China produces 380 tons of gold per year. Russia produces 340 tons. Both countries have been systematically converting dollar-denominated reserve assets into physical gold. BRICS nations now collectively control approximately 50% of global gold holdings. The significance of this is not merely numerical, it is strategic. Gold is the asset that cannot be sanctioned. It cannot be frozen. It cannot be cut off from SWIFT. It cannot be weaponized by the United States Treasury. When Russia was excluded from the global dollar system in 2022, every country that was not an American ally watched carefully. The message received was, the dollar is not neutral, it is a weapon, and any country that holds too many dollars is potentially exposed to that weapon. The response has been systematic diversification into gold, the asset that sits outside the dollar system entirely. Pillar 3. Xi's explicit reserve currency declaration. This is the pillar that most Western financial media glossed over in February 2026, and that I believe will be looked back on as one of the most significant public statements in the history of modern monetary competition. Xi Jinping told Chinese government officials that China should aspire to establish a strong currency widely used in international trade, a powerful central bank, the ability to attract investment and influence global pricing. These are not slogans. They are the specific functional requirements of a reserve currency, and China is not stating them as aspirations for a distant future. China is stating them as policy objectives being actively pursued. The timing of the publication, released as the dollar was hitting 4-year lows and gold was hitting all-time highs, was not accidental. China released this publicly at the precise moment when global appetite for a dollar alternative was at its highest point in years. That is not rhetoric, that is positioning. Pillar 4, the fracturing of BRICS unity as an accelerant, not a brake. Here is the nuance that separates serious analysis from headline reading. On February 2, 2026, India broke ranks with BRICS and signed a trade deal with the United States, agreeing to stop buying Russian oil in exchange for American tariff relief. Most analysts read this as a sign that de-dollarization is failing, that BRICS is splintering, that the dollar is safe. That reading is backwards. India's decision does not mean de-dollarization is stopping. It means the United States recognized the threat seriously enough to offer India significant economic concessions to pull it back into the dollar sphere. Think about what that implies. The United States offered to cut tariffs, real economic value, specifically to prevent an important country from reducing its dollar exposure. That is not a sign of dollar strength. That is a sign of dollar vulnerability being managed through economic incentives. The fact that America had to pay India to stay in the dollar system is one of the most revealing data points of 2026. Now let me connect all 4 pillars to what it means for your money, because this analysis only matters if it translates into concrete financial intelligence. First, the dollar decline is not a catastrophe, it is a slow erosion from 72% to 58% over 26 years. But the pace is not constant. It is accelerating in periods of geopolitical shock, as 2022 demonstrated. And 2026 is another such period. A portfolio that is entirely dollar-denominated is a portfolio fully exposed to this erosion, not dramatically, not overnight, but structurally, over time, in ways that compound. Second, gold's move to $5,500 per ounce is not speculation. It is the market pricing in reserve system stress. Central banks do not buy 1,000 tons per year because of short-term speculation. They buy it because they are managing sovereign balance sheets over decades. When institutions with centuries of financial history move this decisively, the signal deserves serious attention. A gold allocation is no longer a contrarian bet. It is what every sophisticated sovereign institution is doing. The question is whether individual investors will act on the same information before the next phase of repricing. Third, the renminbi story is real, but incomplete. China maintains capital controls. The yuan cannot be freely converted. Its bond markets lack the depth of US treasuries. These are structural barriers to full reserve currency status. The dollar does not fall because a credible alternative does not yet exist. But the dollar can fall without a full replacement. Erosion does not require a replacement. It requires only that less demand exists. Less demand means lower prices. Lower prices for dollars means weaker purchasing power. Weaker purchasing power means your savings, denominated in dollars, are worth less in terms of global goods and commodities. Fourth, the gold buying by central banks controls a signal that individual investors consistently underweight. When the people who manage national balance sheets and who have access to the best sovereign intelligence in the world systematically move out of dollars and into gold for 3 consecutive years at record levels, that is the most credible signal available about where the smart money sees the risks. Not because central banks are always right, but because they are making multi-decade allocation decisions with maximum information and no ability to hide behind emotional narratives. They are buying gold, not for a trade, for structural protection. Let me tell you what I believe is the most important thing to understand about this transition. It does not require a dramatic event to damage your portfolio. The British pound lost its reserve currency status not through a single crisis, but through a multi-decade process of economic erosion, overextension, and the gradual recognition by global markets that a more reliable alternative existed. In 1948, the pound accounted for twice the global reserve share of the dollar. By 1969, the dollar had overtaken it tenfold. By 1980, the pound was at just 2% of global reserves. That transition took 30 years, but it was essentially complete before most ordinary British citizens understood what was happening. The United States is not Britain. The dollar is not the pound. The parallels are not perfect. The timelines are not identical, but the mechanism is the same. Slow, structural erosion, accelerated by geopolitical decisions, the weaponization of dollar sanctions in 2022, and by the explicit strategic decisions of competitors, documented in official Communist Party journals and implemented in hundreds of bilateral trade agreements. The question is not whether this is happening. The data confirms it is. The question is what you are doing about it before the erosion reaches the visible, undeniable stage. Because history is consistent about one thing. By the time a monetary transition is obvious to everyone, the best opportunities for repositioning have already been captured by those who saw it earlier. The dollar's share of global reserves fell from 72 to 58%, while most Americans were told this was a fringe concern. It will fall further, while most Americans are still told it is a fringe concern. Gold hit $5,500 per ounce. Central banks bought record volumes 3 years running. Xi Jinping published an explicit reserve currency ambition in February 2026. It already started. Not approaching. Not soon. Already. Subscribe to Capital Briefing right now if this analysis showed you something about the current monetary transition that you have not found anywhere else. Hit subscribe. Activate the notification bell. This channel tracks the hidden mechanics of capital flows, reserve system stress, banking psychology, and institutional repositioning. The intelligence that comes before the headlines, not after them. Leave one comment below. After everything you just heard, what percentage of your portfolio is currently outside the US dollar system? Write it below, because that number is the most honest financial self-assessment you can give yourself right now. The transition is not coming. It already started. And the gap between those who see it now and those who see it when it becomes undeniable, that gap is where the next wealth transfer will be won and lost.